Good evening, everyone. Welcome back to the channel. So we have a very special guest in house, Jay Pestrichelli of Zega and YieldMax. Welcome back to the channel, Jay.
Thanks, Coach. Glad to be here. Looking forward to
Absolutely.
a very active and informative discussion. There's been a lot of changes since the last time I was here.
Absolutely. So we're going to
Yeah,
do some that I've lined up, and then we're going to go through pretty much all the questions in my Discord. The
great.
first one, the hottest topic, the TSLY reverse split. Um, some people thought that wouldn't happen until $5 a share, but it happened at 10. Can you kind of explain that one further?
Yeah, sure. So, the thought here is you don't want to get below five, right? Because things like margin gets pulled, it starts to get kicked out of certain, balanced portfolios. So you want to take care of action before you get to five for sure. And then the other thing is, we always talk about share count, how it's important to continue to kind of like reinvest. And if you did like, a 1 for 3 or a 1 for 4, it starts to like really diminish and people lose partial shares, right? So, if you had 11 shares and you did, the 1 for 2, you get 5 and a leftover. But if you did the 1 for 3, now I've got, 2 extra, right? So we just thought, better to do it sooner than later. We saw, look, who knows where Tesla is going to go, but we're trying to read a little bit of the writing on the wall and get ahead of any kind of negative impact of losing partial shares. And like I said, we definitely didn't want to get under the $5 mark. So it was, might as well rip the Band-Aid off on that one, get the first one out of the way, and let people kind of see like, oh, this really isn't that bad of a thing that happened here.
Right. And the first week, it really did great for it. It was starting to come back, but the underlying just it's hard to overcome that underlying.
Yeah, you look at that chart on Tesla, lower lows, lower highs, it's kind of going the wrong way.
Hmm.
It's unfortunate it's the first one, then the one we have the longest track record, but that's the way these things go.
Well, like I'm going to point out later, and as you know, OARK debuted around the same time, and it's actually up like 21% in total return.
Yeah,
Yeah.
it's doing better.
Hmm. As
So it
far as
was not always the case, right? I think we started
right,
out and ARK was worse. Yeah.
exactly.
Yeah.
As far as the reverse split topic, do you foresee any others coming, and would they all be around $10 if so?
I think if we saw sustained, below $10, then it's probably something we would consider. There's no hard and fast rule here, but again, we're trying to have the least amount of impact on the shares that folks hold, and then we also have those other considerations like portfolio inclusion and margin and those kinds of things.
Okay.
I mean, the margin one, believe it or not, is a bigger deal than most people think. We have a lot of individuals that will buy YieldMax on margin and let the distributions help pay it off. That's not something that I recommend for everybody. Margin is borrowing, margin is leverage, margin can add risk to an already volatile underlying. But we know it's a use case for it, so we don't, we try to anticipate and assuage that problem the best we could.
For sure, for sure. The other topic we've had a lot of questions come up about, there's been a lot of competing funds that are debuting. We've got Defiance, Rec Shares, and Curve funds. Do you see YieldMax doing any more funds that would match these types of funds?
Well, I think we have Defiance is unique in a lot of ways, right? Defiance are more like index based. We're familiar with the Defiance funds. We actually are the sub advisor on those funds as well, so we trade those. But YieldMax is a different brand, right? And it has a different mantra on what it's going to do and a different build. Rex and Curve, also familiar with those guys. I think everyone that they have, we have. I mean, I think Rex has one that's kind of a more amalgamation of a handful, but I think we've got something that's interesting and ulti that competes. So, I look at those. We definitely have a different approach. The funds have a similar concept. We were live first. I'll do a little self-commercial here, right? We kind of help break ground here. We're the first with the synthetic, right? But I also think they differentiate from us in a bit by they pick different strikes, they go out farther. We're more about yield, yield, yield. Hence, our distribution rate is higher than and those. And I think you've seen the flow of either daily volume or the assets into YieldMax continue to outpace all of those other funds that have come out.
So along those lines, the Curve funds and some of the Rec Shares, they actually pay a lower dividend, but
Right.
the principal is protected more. I know, like you've said before, you're called YieldMax for a reason. But do you ever see a scenario where you would consider paying a lower dividend to preserve more principal?
Yeah, I think I want to use the right term here, right? The principal for them is not protected. They have the exact same risk as any other covered call strategy, as I believe. And I'm not, well, I'm from, I've looked at the structure from time to time. I haven't looked recently. There's no like long put there, right?
Mm,
So what they're doing is definitely a little different. For us, it's generate the yield, right? And that is our primary function. I will say we have had conversations about maybe some making. Well, I can't go into too much detail, but it's for us. It's not so much like maintain the nav at all costs, right? That's not what it's about. It's about using the underlying to selling calls for income, distribute that income. We've kicked around reducing the frequency of the dividends and the
yes.
distributions, but in all honesty, we trust people to use those distributions the way that they need to, right? And
Hmm.
understand what it's going to do to the nav versus letting it kind of run up a lot and then hit them with a big distribution. So, yeah, I think the structure is what it is. It is what's in the prospectus. So, no major changes that I could talk about at this time.
Right. And then on the topic of inverse funds, do you still have a lot of other YieldMax funds like on the docket? And would any of them possibly be like inverse funds?
Yeah, so we've filed for 6
Six.
inverses.
Okay.
We're in that period between filing and launch, so I can't talk too much about it.
Okay.
But yes, like they have been filed, and read those prospectuses if you want to get an idea of what they are. I could tell you the underlying tickers. I believe that's in the prospectus, so I could say what's in the prospectus. Uh, the inverses will be that we filed for are Tesla, ARC, Coin, Nvidia, Apple, and the Qs. So those are the 6 that were filed. Nothing more that I can really say about those, except as an options guy, I'm really excited to get those rolling.
Awesome. Now, next question I'm going to take from the comments, then I'm going to switch to the Discord questions.
Sure.
Someone brought up the NVDY fund and the way that Nvidia stock has been running up, there's a split anticipated. So how would YieldMax handle it if the underlying splits?
Yeah, it shouldn't affect anything for us. The strikes on our options within the portfolio will change naturally, right? Where did Nvidia close today? Was it like 900
It
something?
gained
I
another
think it was.
$60.
Yeah. So 926. So yeah. So like, let's say they went one for five for one, right, and went down to like just around $200. All the options we would have, the strikes would change, but and the multiplier would change. All it would mean is the pieces within the portfolio would change a little bit, but none of the return factors or anything like that would actually change. And then once we got through that synthetic period, the synthetics we had, and once we sold the different calls, it would we just moved to those. So it wouldn't. By the way, it wouldn't cause us to split
Okay.
NVDY. That wouldn't happen. There's no reason to, because the way an ETF works, it's your assets divided by your shares. That
Hmm.
gives you the NAV, right? So we didn't change assets. We didn't change the shares, right? Like we did with the TSLY reverse split. So I don't believe it would make any difference in the NVDY NAV at all.
So then there would never be a scenario where a YieldMax fund would split.
I wouldn't say never, but
Okay.
like if we're over 100, and look, if there's any ticker that'll do it, maybe it's Nvidia, or
Right.
it's MSTR, MSTY, maybe that one. But
That one's
um,
crazy.
that's been quite the ride out of the gate. But no, I wouldn't expect them to split, like have a forward split. No,
Hmm.
you never know.
Right. That's good to know. Yeah, I think that was the main concern was if it would split like NVIDIA. Okay, I'm going to take one more from the comments section here. Someone had a concern about why do you guys wait until expiration to sell the option if it's profitable?
Yeah, I guess that means cover buy, right? The
Hmm.
sell, I think, or close out of a position.
Yeah.
We won't. We'll close on a Wednesday, Thursday, Tuesday. I mean, we've done that before. So the goal here, right? I'm sorry, I'm going to be a broken record. Earn yield. It's our
Hmm.
primary goal. So once the premium has dropped down to that level where we will then cover buy, we'll do it. It doesn't matter what day it is. We don't always wait until Friday to do it. We certainly do it plenty of Thursdays. I'm sure there's some that are going to get covered, this week early. No, it's not always the case, but the case is we want to earn all the time decay first, right? So that's the most important part. If we sold an option for $2, we don't want to cover it back at 50 cents, meaning we only earn 75% of our target. We would let that run all the way down to a dime or something like that, because that's the goal, right? Earn that $2 for the single week.
Right. Okay, so next question from the Discord. This person says, I'm a long-term investor looking for covered call exposure while realizing more capital appreciation. Would there be any new funds released that are more conservative that might lead to that objective or along the lines of that objective?
Yeah, it's a little bit of a different product that's more about upside capture with income. That is different than the priority of YieldMax, which is primary, generating the the higher distributions and income. So it's just a different product. Is it one we've talked about? Yes. Have we filed for anything there? No, but definitely something that we've considered. Look, I would say this, right? For those that want to naturally create a position that's got more upside, do a blend of the YieldMax and the underlying ticker, right? You'll naturally build your own kind of version. So if you said, look, I don't need to make 50% on Tesla, I'm okay with a 20%, then just build long shares of Tesla with long shares of TSLY and get your upside capture that way. For us, we think the pure play gives you the most ideal way or the maximized distribution that we can deliver. And then you want to mix an upside, buy some long stock. Like that shouldn't be too difficult, right? I mean, we could even do the math, right? Hey, I want 25% yield, but Tesla's paying 50, go half and half on the long stock. The only downside is like there's some of the stocks like Nvidia that have such a high price. If you don't have $2,000 to invest to buy, a share of Nvidia and then however many shares you need of Nvidia, you might not get the right ratio. But that withstanding that, generally, I think you can create your own upside by combining those two positions together. And then when you get your yield, reallocate the two. As a portfolio manager, we do that all the time, right? We regularly rebalance positions based on the target exposure that we want. It's not a hard thing to do. Just, do a little math to figure out your market exposure, market value that you want in each piece.
That's actually a great suggestion, I think. But along those lines, what would you say to anyone that says, I would rather just be a growth investor because there's a lot more upside to be had that way? Like just look at Nvidia, like you said, up like 200.
Yeah, these are not growth. These are not growth ETFs, right? They are alternative income. Now, we happen to be using high growth tickers that, well, I guess not Tesla, but you happen to be using, I'm kidding, Tesla lovers. We happen to be using those underlyings that have all the volatility. These are not growth funds, right? If somebody said, I want maximum growth, covered calls are not the way to generate maximum growth. They are not. Covered calls are designed to generate alternative income. These, I would say, are aggressive alternative income because they are being done on underlyings that have quite a bit of volatility. I think the YieldMax fund of funds can be a nice go-between there if you want to reduce your volatility. But when it comes to growth, you shouldn't really ever expect over the long term any covered call to outperform. The idea of YieldMax is generating income, alternative income that's not tied to bonds, right? That's kind of the main thought behind where this should fit into a portfolio. So, these aren't growth. Look, it's great. Like when you look at a stock chart on CONY or NVDY, you can't tell those are covered call strategies, right? We are definitely capturing a lot of upside along those. Like if you look at, the typical at the money covered call strategies like QILD or JPI, they're never going to have a chart that looks like what some of the tickers like that we're managing today. So I think we're doing a fair job of capturing the upside, but it's again, not our primary. Primary is income. If you want growth, buy the underlying. It's always going to be the more growth oriented position. Carries more risk because you're not buffering it. Buffer's the wrong word. Sorry. Muting the downside with income. But that's okay if growth is growth. Different stuff.
Yeah, makes total sense. Along those lines, what would you consider to be like the profile of like the ideal yield max investor?
Well, that's all very different, right? I think there's a spot in almost everybody's portfolio for a piece of yield max.
Hmm.
Again, it's all based on, now you're talking more portfolio theory. But look, generally, the way I would categorize these is alternative income and aggressive. I've said that. Sorry to repeat it. So what does that mean? So let's say you're 50 and you need some appreciation before you can retire at 60. You have 10 years. Having some aggressive allocation is very appropriate, right? Those are like those years where your portfolio can work harder than you can if you've been saving throughout time. And even if you haven't saved too much, you get to the point where you're the 15% you could put away a year if you can isn't going to be a dent compared to how much you can get in growth. And so you want to have growth pieces. So I think it's appropriate there for people that are in the accumulation phase. And then if you're in retirement, like I get this question all the time, like, hey, can I live off the dividends of YieldMax? Well, we've talked about reinvesting, and we've talked about the idea of putting the dividends back in. Otherwise, you're just divesting to cash. But sure, you can. You can't take $100,000 though and take all the yield out all the time, all the distributions out, and expect to still have the $100,000
Right.
unless you get a very bullish stock like Nvidia or Misty or Coin, or I mean, there's a handful of them that are trading even over our launch price of $20, right? Plenty of them. I think Meta, the FBY, is doing well. So all
Yep.
of those things may help over time, and that's fine, but you still need to have the underlyings that grow. I like YieldMax in that scenario where somebody wants income and really decides to pull it out because you've reduced your volatility, because you have a diversified portfolio. It's not all, what happens if all of a sudden Apple loses 25% of its iPhone sales in the first 2 months of the year. We also what happened at Apple when that news came out, right? That's idiosyncratic risk. But you use YieldMax during that time period, you've eliminated some of that. You have a more broad approach. So again, it's that one's a little more conservative. You can always go conservative, right, with JPMO or XOMO. Like those are obviously less volatile. So it's hard to say here's the ideal client. What I would say generally is somebody that's sophisticated enough to understand how to work the yield, right, how to work those distributions, when to reinvest. And the other thing that I would add is somebody that understands how alternatives belong in a portfolio versus just stocks and bonds.
Hmm. While you're talking, I'm just going to show the audience. I have some Seeking Alpha windows opened on the 21 YieldMax funds that have paid dividends, and I was even surprised myself because, like we were talking about the negative press that's been out there, but most of these are considerably up. TSLY obviously is the worst one since inception, down 16%. But in this first view, Aptly, AMZY, well, GUI is down since inception, but
Yep,
NFLY, MSFO, I mean, these are significant, 35% total return since July. MSFO 28%, JPMO 16%. I was somewhat surprised myself, actually, but like you said, when you look at these with total return, you wouldn't exactly know off the top of your head that that's a covered call ETF.
that's right. I mean,
Yeah.
those are right. You're getting some appreciation there. So I appreciate. Thank you for the props on that. That's good. I
Yeah.
mean, this is the thing. While the NAV is always the tricky thing, I just think the investment community isn't used to this yet.
Hmm.
They will be. We
Well,
will
the
be.
one thing, like what concerns me, I hear a lot of like people say older in age and they get excited by the high yields and they say, "Oh, I want to put everything in this." Like me personally, I would probably caution against that. Like I said, and
I
you
would too.
mentioned
By the way, they're
yourself. Yeah,
aggressive, right?
yeah,
They're aggressive.
yeah. And you do consider these funds risky. Well, all investing technically is risky, but you do consider these funds to be risky.
Yeah, on a scale of 1 to 5, 1 being risk-free treasury bonds, and 5 being crypto, I would say they can be, depending on the underlying, 4.5, right?
Wow.
Or they could be 4. Well, like in our world, stock risk is considered one of the riskier investments. I think your audience, coach, is probably a little more on the fact that we're talking about yield max, probably has a little more of a risk tolerance, but when we assess stock risk, that's like a 4.5 out of 5, just stock in general. And
Hmm.
covered calls absolutely take stock risk. So that's why I put it there. look, is JPMO going to be as risky as NVDY? Nope. It's going to have less standard deviation. It's going to be a smoother ride. The returns have been strong in that. But, when the market does a 2022 or, a pandemic 2020, it's all going down, right? It's all going down, maybe at different rates, but they all take that risk. So that's just the thing that, to me, it's important for people to get that these are what I would consider aggressive alternative income.
Perfect segue into my next question, which I almost forgot. So, based on what you just said, do you foresee, like, if YieldMax had launched in, say, 2020 or 2022, like, where would we be? I mean, would one of these ETFs potentially go, I don't know if bankrupt is the word, but if we were in that kind of environment, like, what do you
There'd
foresee?
probably be a few more reverse splits, but the
Yeah.
beautiful thing is the yield would be higher. So while we launched in November of 2022, we didn't just come up with the idea in 2022, right? The research on this started in January of 2022. So believe it or not, in our initial research and build out of Tesla and Apple and ARK, right? Yields were significantly higher because vol was higher in the market, right? We've talked about that connection between the implied volatility in the market and then the yield of the underlyings. I'm going to tell you, I continue to be disappointed by the lower implied volatility of ARK and Tesla. Like, come on, guys. Like, what the options market is just keeping it kind of muted right now. I'd like to have a little more vol in those. So, to answer your question, there probably would be more declines, obviously, because we take the underlying risk. There might be more reverse splits. We might have had one sooner than we just had, but the return would the distribution rate would actually be significantly higher. We're actually in a muted volatility world right now, right? VIX. I mean, when's the last time we even were over 16 on the VIX? Did we pop over for a day recently? Like, yeah, I
Good
mean,
question.
it's like it's vol has been a snoozer this year. It really has. You look at all the kind of the potential warning signs out there, and they are really all muted. Obviously, the VIX is important for us to watch, but you could even look at the high yield spread against treasuries. No worry in the high yield space. So there's been a lot of indicators that it's just been a lower volatility regime. I love the fact the market keeps marching up. It helps all of our covered call strategies, which are generally bullish. That's the concept. Covered calls are generally bullish.
Yeah, that's a great point. I think the last time the VIX was above that number was probably October.
Yeah, like significantly over it. Yeah.
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 Yep.
No, it's been. Now I got to look at a chart because I brought it up. But yeah, I mean, we closed today at 1384.
Yeah.
You look at. I guess we got a day. In Feb 13th. Oh, I remember that. That was kind of a not great day, but it's still just closed at 1585. So you're right. The last time we had a close over 16 would have been November 1st. November 1st. Yep.
I'm glad you pointed that out, by the way, about risk, because so YieldMax has become an issue almost like everything else in this day and age. There's obviously people that love it and people that hate it, and there's not much of a in between. And literally, like, there's other discords on here that ban people for saying it's risky. So you mentioned 4.5 out of 5 on the risk
I mean,
scale.
that's where I would put it, right?
Yeah.
Like I don't know, like Coin did what was the round trip on Coin that we had recently, right? And look, I know I'm picking one that's extra volatile, right? But
I actually have that one up here on the screen.
yeah, like
So
take a look at the chart on
yeah.
and even CONY, right? Just put that one up there.
Mm-hmm.
And right, we ran up to $30, dropped down to 19 in like 2 months. Now, some of that was distributions, of course, but that doesn't feel like what grandma should be in, right? So yeah, I mean, just know what you have there. It's so important to understand what you're buying.
Yeah, the view that I have up here, again, this is the total return. I've got them in increments of 7 because Seeking Alpha only allows you to put 7. But CONY, we're up 116% since inception in total return, which is phenomenal. FBY 38%, NVDY 103%, and even like we were talking about before we went live, OARK 21% since inception. Oh, I'm sorry, that's actually that was March, 7%. I'm sorry, I had to go a little further.
That's okay.
Yeah, 113% for NVDY actually. 118% for CONY, according
But
to
you had,
this.
like, if you look at the CONY chart, like highlight on that icon again
Yeah.
there for a
Yep.
second, right? Or maybe just go on the little button. Yeah. So like,
This one.
yeah, you could see, right? It almost hit 100 and then it pulled back to where is that, almost like 25-ish, and start to see
This is
the
in
pullback there.
percentage.
Yeah. So like,
Yeah.
where's that dip that you see on CONY there, right? And it went up and then it pulled back, right? That's probably like 25%, right? So we went from being up 100 to up 25.
Yeah, we were at the end of the year, we were $30 a share. Then we dropped to like 19.
Yeah.
Yep.
So that, that's why I say 4.5 out of 5 risk.
Hmm. But yeah, other than
And I put that one
those two
probably at 5 out of 5.
for CONY.
If that's not 5 out of 5, I don't know what is.
Yeah. And then yeah, MSTY is crushing it. And this is only like what, 3 weeks old?
That one is kind of that there's a great example of, timing is everything. We didn't know that. Obviously, we we didn't know. I think because we always launch at $20, the math is, and we haven't had a dividend yet. I think at, where do we close today? 37.12.
Mm-hmm.
I think that's like 85% in 3 weeks. Like and that's not a leverage fund, but we all know it's on MicroStrategies, which is generally considered leveraged Bitcoin. So yeah, so while it's not leveraged itself, it's getting the tailwind of Bitcoin and the tailwind of leverage from the underlying. But who knows? I don't know where that one's going to be in 3 weeks. But that one has grown obviously very quickly. I think I saw in the comments like, hey, what's the yield going to be on this one? I would, we always get that question, right? Like, what's the first yield going to look like? And I'm, that obviously, while we don't know yet, the period isn't over. Always use the implied volatility as the base, right? When you look at the IV of MSTR, I'm sorry, right? I mean, it's like 150% implied volatility. Like that's when we put our positions on, that's what we're shooting for each week, to sell options that'll generate that much. And then you get the sometimes kicker of the large run, right? So while I'm not telling you we're going to have 150% yield, I will tell you that, and I've always told you, we target the income that we sell each week based on the implied volatility of the options. So hopefully that answers a question that a lot of folks are going to ask.
Yes. Now, tomorrow is the dividend announcement date for like the fund of funds and the ultra. So can we expect a dividend announcement for Ulti?
Yeah, Ulti's in the queue. You're going to get it. We filed it with the New York Stock Exchange early on, so you'll get an Ulti number. It's only been live 9 days, so remember that, right? So it won't be like a monthly run rate. It'll be, here's what we made in 9 days, right? So you could do the math on a month what that'll be. But that one is, from a trading perspective, one of the most interesting funds I've ever traded, or strategies I've ever traded. Mm-hmm. Right? We're regularly, I mean, we could go into more detail on this one, but you will get an Ulti announcement along with YieldMax and YMag. I don't know, 8:30, 9 o'clock in the morning tomorrow.
Awesome. Say what you were going to say about Ulti, because I looked at all the stocks. You've got like Carvana, you've got Sound, you've got a lot of different ones in there.
Yeah. So so what we'll do, the process for this is, we are looking for stocks that meet, option volume criteria, market cap criteria, all stuff that's stable enough to handle our trading. But we're also screening for implied volatility. And so we're looking for tickers that have significantly higher volatility. And so when you think about that, if you were to look at the IV of those, I'm just pulling them up, I'm looking at my list right now. When you look at the implied volatility of those, they range from 130 to 80, right? That's kind of the IV of those. Believe it or not, when you look at the options that we're selling each week, the implied volatility is even higher on those. So again, that's kind of a guide for what we've done in the first 9 days of Ulti. But we will change out the positions, right? The 20 that we have today are not the 20 that we had when we first launched. Probably half of them are still there. We've had some that have had calls that, the underlying went through our calls. We closed out the position, maxed out. Some have dropped, and we dropped those out, right? We've had a couple real stinkers in there so far. That's the risk of an Ulti, where, we're not going to pick winners every time. I would tell you, I would feel extremely successful if I picked 65% winners, right?
Hmm.
That would be great. Now, what I do know we're always going to get is that cover call income that we're going to do every single time that we hold the stock. So, it's a regular screening process. As money flows into the fund, it has grown fairly quickly. In the 9 days that it's been live, I think we launched seed money was about 2.5 million. I think today we'll close well over 15 million. So it's grown significantly in a short period of time, which tells me that folks are optimistic about what the yield is going to be and about the idea of this ultra active management of not only the option positions, but the underlying tickers as well.
Right. This is a good segue into the next question. So the
Sure.
expense ratio on this one, it says 1.14%, but there's like a 10 basis point discount on it. Or is that what that
No,
is?
that's right. That's right. I think
Okay.
it's a little more than 10. I think it was, I don't know, maybe it's 15. I can't remember exactly, but you're absolutely right. So we're kind of waiving part of the fee out of the gate.
Hmm.
This is an expensive strategy to run, right? I mean, that's why it's higher. It's the only YieldMax. Well, I guess YMAX, we state a higher, that one's only 29 bips, but then you have to include the underlying. For Ulti, yep, this is kind of just, it's pure extra work. It's pure extra screening. It's not like we set, we're just doing one trade a week or just doing the rolls. This is daily, portfolio alternating between the positions and, assessing the volume. So, and the volatility. It's a lot more work for our team. It's actually, believe it or not, we place more trades in Ulti each day than all other YieldMax combined.
Wow.
All, yeah.
Hmm. So we did have a question about expense ratio on the other ones. Most of them are 0.99. Some of them are 1.29, I think, for YMAX and YMAG. The question was, is the expense ratio amortized monthly, or is it taken out quarterly or annually?
Believe it or not, it comes out a little bit every day.
Oh, okay.
A little bit every day. Yeah. So YMAX and YMAG, yes. Well, we have to state though 1.29. It's
Yeah.
actually just, I think it's like 29 bips, or maybe it's 1.24 and it's just 25 bips. But you have to include the expense ratio of the underlying holdings. You have to pass that through. So you don't, you have to have transparency on that. So the effective, fee, because we hold a bunch of 99 bip funds and then the 25 or 24 over the top of it, is how you get that total number. And again, there's just costs, putting out that kind of a product, right? They have to be paid for. So, but it comes out a little bit every day, right? So if you have a 1% fee, it'll be one, I guess is it 1/250th a
Hmm.
day will take out of the NAV.
Right. Very interesting. Um, yeah, and it's funny because you guys have such fans out there. All I did one time was point out that it was higher for YMAX and YMAG, and I kind of got attacked. Someone said, "Oh, it should be even higher."
It should
So
be.
yeah.
I actually said it should be more.
So you
I have
the
a full-time employee basically dedicated to that strategy, right?
oh
That's
wow.
one person's life.
Wow.
Yeah.
That's interesting. Okay, let's see. Yeah, I had Ulti up here on the screen, so we got that one out of the way. I was going to show the last batch of the funds that are, just the total return since I had that
Sure.
up. Let's see. So I showed the middle one,
Wait,
and
I
then
gotta ask one question.
go
Somebody
for
wrote YieldMax killed my dog. I gotta know a little more about that, Crockerfeller.
it. We did have a lot of silly questions in the Discord. Believe it or not, Blake Downer, my co-host
Sure,
on
of
my
course.
podcast. You'll be talking to him. So he pointed out a strategy that you have referenced in your book, Buy and Hedge, literally hedging these funds. You would say you agree with hedging these funds with, like, say, put options and
Yeah, I mean, and look, I'm not. I can't trade these funds for I can't trade the options on these funds for my client because we're the ones that determine the dividends, right? Like I could
Mhm.
impact the end result, so I can't trade them. But I would tell you, there's absolutely collar strategies, synthetic strategies here that if you're savvy enough to trade options on these tickers, there are some very interesting ways to generate much, much lower volatility. Now, of course, you'll give up yield. All things are, always weighted, but you can absolutely trade the options on these. I'm sure somebody would love for me to go into one. So let's
Absolutely.
take, yeah, let's do Nvidia for a minute. So I'm just going to look at the maze. It's 2 months out. Right. So when you look at, it's hard to see here in after hours, right? Because we don't have great pricing. But, if you take a look at kind of where these have traded, you can create protection and knowing that a lot of it can get paid for by the distributions, right? Now that would reduce the amount you could reinvest in all kinds of things, but your put should make you money after. The market does not change the strike. And when I first started trading options in the 90s, large dividends would cause the options to restrike because it was just too big of a move. 5% in a single month was kind of unheard of, right? So like sometimes with a large one-time dividend, the options would restrike. They're not doing that these days, especially on the YieldMax funds. And so when if you take a look at, I'm just kind of seeing here, like the 26s, right? The 28s, right? It looks like there was no trades on that one today. I want to find one that had a trade. So let's take the 25s, right? So the 25 May puts looks like there was a trade at $3.32. So, if you're going to pay that amount of money for the protection, which happens to be 13% down, that, in my opinion, is probably a little on the expensive side. However, right, because that's going to run you about 30% a year. So you can protect yourself buying a 13% out of the money put. It'll run you about 30% a year to have that. But if your yield is 60, 70, 80, 90, 100, it more than pays for that. And you've created this, little bit of protection that if Nvidia did pull back to say 500, in that scenario, you protected your underlying. And then as those distributions come out and that pushes the Nvidia lower, that put will go up in value. There's also ways to do synthetics on the synthetic strategy, right? Put on a synthetic short, create a neutral type position for yourself, earn the yield on the ETF, and then use the options as kind of an offset. So there's all sorts of ways that you could use the options to protect yourself. Like you said, the book I wrote was in 2010. Thank you for bringing it up. Mm-hmm. It's concepts absolutely apply today, right? There's some things that need to get updated in that, but the concepts and the way the options work, it's absolutely still viable. And the idea of reducing volatility for long-term investing still applies. The math is the math. I don't care how old you are, compound interest and, all of that stuff still applies. So I would say you could use options on these. I can't. If I wasn't trading these, I would be trading the options on these.
Mm-hmm. Very interesting. And so, to be clear, you are saying it's a good idea if somebody wants to hedge to do that.
I am. I am, right? And use puts or put spreads. Put spreads are a great way to affordably, hedge. In that example I just gave you, right? If you buy the 25 call and it costs you 30% a year, annualized, these are annual numbers, right? And then you turn around and sell a 20 call for 20%. All you did is spend 10% on an annualized basis if you can get those trades to go, right? So again, this is, we should do this during market hours and do some live trading one of these days, Coach. That'd be pretty fun to do. But
absolutely, if you're available one day for that.
Sure. Yeah. I love nothing but trade. I love trading. That's my life. So I think looking at the way that those work might be really interesting. Obviously, TSLY has a lot more option volume in it. And I'm looking at the open interest. Like there's trades today at the 17 level on those. And you could sell the 17s. Looks like you could sell the 17 call for 25 cents.
Try to pull the options chain up while you're talking.
Yeah, that'd be great.
I've got Nvidia. You were talking about Nvidia before.
Yeah, let's switch to Tesla. It's a little more liquid, liquid here, right? Throwing a
Tesla stock.
TSLY.
Don't use
Tesla stock to hedge. You can, but you're not really getting the value of what's going on in the yield. Yeah. So let's look at the. Let's go out 2 months. Let's take a look at the Mays, right? May 16th, right? One of the things you could do here is looks like the 17s had a trade, the call at 35 cents, right? So you could sell that call at 35 cents. you can then turn around and use that to buy yourself some protection farther down in the chain, right? Or you could, use it to kind of create a collar with another short put. So sell the 17s, buy the 15s, sell the 12s, kind of a deal, right? The 12
Okay.
puts, right? Buy the 15 puts, sell the 12 puts. And I know I'm going really fast on this. Nobody wants to hear me talk too much about option strategies, but those are ways to kind of reduce your volatility in your position, and you have an idea of what you're going to get paid in distributions. Last month it was 80%. If the volatility stays the same, you're going to have a similar rate. Of course, if the stock goes down, we all know that the dividend will drop, even though it's the same rate. All of those types of things are, certainly interesting to watch for. But there's things here where you can anticipate some level of. I think we've got enough history now that everybody can have an idea of what to expect from the yield and the distributions. Use some of that to put on your protection and reduce your risk. Like, I'm absolutely a fan of that.
Mm-hmm. Awesome. Great to hear. Glad we went over that one there. And then, yeah, because having a little fun, Blake actually got banned from another Discord for suggesting that very thing. And he writes for Seeking Alpha. He's a smart guy,
Sure.
So anyway, not to talk too much about that. All right, our next question in the Discord here. We went over Alti. How many funds does one person? Oh, let's just do this. We'll translate this too. So your staff, you have several like active traders.
Sure.
Your staff,
Yep.
right? Yeah,
We
just talk
do.
about that.
Yeah, I mean, there's 4 full-time traders, and we're adding as we grow. One of the fun things about a business growing like ours is with YieldMax is you get to invest in the technology and make your traders more efficient, right? So the main platform we utilize for executing our trades is Bloomberg. It's not the cheapest, but it is by far the most widely accepted kind of platform that we use. And as you grow, you can't just add bodies all the time, right? You have to get yourself more efficient and remove human error. So we're making significant investments in both the technology we use. Bloomberg is actually building us custom builds for our portfolios and active management, and then also adding bodies. We have actually 2 locations. So while I say we have 4 full-timers, there's also 2 other folks, including myself, who hop in and trade from time to time. I'm more of a queue up the trades and let them fill them, right? As more of what we call the PM or the portfolio manager. But there's 2 of us that do that work and 4 of us that are executing the trades during the day.
Awesome.
Not to mention the whole rest of the staff. Like Zega's I think we're probably at 15 people at this point. I know that seems low, but we've always gotten by very well by using the tools as much as we can. We are not old school, cranking out things on a spreadsheet, right? We kind of build our own stuff. We have a technology spend where we have developers really across the world building stuff for us. One of our developers, I don't know if this matters or not, it's not meant to be a political statement, but we use a firm out of the Ukraine, right? And they build stuff for us today. They're actively working on a new system for Ulti for us, for example.
Very interesting. We might have brought this up before. Do you plan on any crypto YieldMax ETFs?
We have filed for a crypto YieldMax ETF. Yes, can't talk too much about that, but we have filed for one. But look, I mean, would you say coin and MicroStrategies are crypto? Yeah, I would. We use a crypto benchmark for those, right? Because they're so driven by the price of Bitcoin. So
also Ulti has some MSOS.
Ulti definitely has some crypto in it. MicroStrategy is in it. Riot's in it. Coin is in it. Mara's in it. We will limit our exposure there to like 25% in any given sector. And I would tell you right now, all the volatility is in, that application software, which is where all of the miners fall. So, yep, we definitely have probably maxed out our allocation to that just because it's where the juice is. It's not a preference. I'm not bullish Bitcoin over, industrials per se, but that just happens to be where the volatility is right now.
Right. Circling back to a statement you made about implied volatility. So you said look at implied volatility as a basis for the dividend each month.
Yep.
right? So we could, and I know a lot of people try to do this, but we could sort of estimate the dividend just based on implied volatility itself.
Yes.
Yeah. Awesome. Okay, just wanted to clarify that.
Yep.
Okay, next question. And I've gotten this, so I asked questions that we've gotten like several times. There are people out there that feel that the team overpays in distribution when not enough premium has been made, and also being too close to the money. So I guess two-part question. Do you see yourself ever spreading the strikes out more again? And what do you think about this idea of overpaying uh, in distribution when not enough premium has been made?
Yeah. Let's talk through those two things. So let's do
Hmm.
them in backwards order. So we will distribute what we earn from selling calls. There are times when the stock is going down where our synthetic, right, the long piece, the long exposure, loses money. And we realize a loss on that because options expire, right? This happened to us in October. Almost all of our options expired while everything was going down, right? So you got to close those and do new ones. You realize a loss in that perspective, right? And that's sorry, in that situation. But to keep it in perspective, we still will always distribute what we earned from selling calls. So if we still made our 1% a week in TSLY, if that's my goal, right, we still earn that. I'm going to distribute that even though I actually realized losses for the month. This is what's known as return of capital. And in the past, this was a very touchy topic for people because investors said, well, you just give me back my own money, right? Somebody put money in and you just gave me their money. Is this a scheme? And the answer is with option
Yep.
strategies, it happens all the time. You
Mm.
look at SFOL, you look at QILD, you look at JEPI, all return capital because of the dynamics of the options. I'll give you a flip. So what I would tell you is we are always committed to delivering in the distribution what we earned in selling calls. Sometimes, some months, we don't make money all 4 weeks selling calls, right? Sometimes we have to roll a call and we don't make all the juice that we wanted to make because we're trying to lift up the cost basis a little bit or change the strike a little higher. That can happen. And sometimes it may come in a little lower, right? Which is why if we do come in lower than the IV, that there was some trading involved that caused us not to earn all of our covered call income. But we will distribute what we earn in selling calls, regardless of what the underlying does. And so it may appear that we're over distributing just to have a higher distribution. And that's not the case. It's always driven by, we track what we make every day selling calls. I know there's a lot of folks out there that are also tracking what we make every day from selling calls. We
Yes.
appreciate that. We watch that. We enjoy seeing everybody's analysis. Thank you very, very much.
Mm.
But I don't know if I look at everybody, but I know we look at some from time to time. But there are times where that cover call will lose money. Like if like when a stock appreciates so much that it goes through a call. We've had this happen in every one of our funds where you sold the call for $2, but it cost you $10 to get out of it, right? I just lost $8 on that trade. I'm still going to distribute $2 because I earned $2 of time decay, right? Even though I lost $8 on that appreciation, I know I made it on the synthetic, and maybe I'll roll the synthetic to earn that to offset that, but maybe I won't. It all depends on where we are in the cycle of the trades. But it's all about the time premium we earned every month. That is the main driver of the yield.
Awesome. Yeah, great answer.
The other question, sorry, there was another question about return of capital. Sorry. Will we sell farther away? Sometimes we sell too close.
Yes.
Again, it's about hitting our income target. And for those of you that watch, there are times where we go a little in the money and we only roll right at the money. We're still doing the math on have I made my, we call it internally, we call it, did I hit our bogey, right? Can we hit our bogey of our yield number, right? If it happens to be like Tesla again, 1% a month, 1% a week. If I can hit that $1.75 and roll to right at the money, I'm okay with that, right? Because I'm still earning my bogey. If I can get farther away, I will always get farther away. If you look sometimes, and my compliance may not love that I'm about to say this, there are times we deliberately go outside of the prospectus on where we sell our calls. NVDY earnings, we were selling farther than 15% out of the money. MSTR, we are selling farther than 15% out of the money. We're in a very strange period of time. And the prospectus allows us from time to time to stretch, because we use the term generally. What's going on in crypto right now is unique. What goes on around earnings sometimes is unique. And so we will stretch it in those periods of time. And sometimes the option market just gives us the answer, right? Coin has been one that, we expanded how far out of the money we've gone, and it might have rose to us or it might have did not, but we definitely will move the strike higher when we can, because upside capture is a secondary goal of the fund.
Great answer. Very transparent. This is a regurgitation here of something that's already come up about the synthetic covered call strategy. Since opening of TSLY, Tesla stock's down 25%. Oh, he's looking at just price return, not total return.
Right.
But
Right.
why so much magnitude of downside? It's the way the underlyings moved, and it's the volatility.
And the distributions, right?
Yeah. Yep.
You kick out 80 cents on a $18 ETF. That's a pretty large dip. So don't look at price, look at total return. Again, folks will get used to that over time. It is definitely a unique characteristic of these very high yield type products. I'm going to say high distribution rate products. Maybe that's a better way to say it.
Okay. We just had a question come in.
Sure.
Why aren't synthetic positions being pushed out with a 6-month to 1-year expiration?
Great question. So the structure of this is a technical answer, because initially when we wrote the prospectus, I thought the same thing. Let's go out a year. Just leave it on for a year. Let that thing just be on. It doesn't matter. It's going to be a 100 delta position. But unfortunately, in the ETF world, you have what's known as concentration requirements. You can't have a concentration of greater than 25% of any given company values. So in other words, if you go out a year, I'm just going to take a look at Tesla itself. If I was to go out, and you could look at the option chain yourself if you want to, but if you go out to say, where's the 1-year mark? Let's say we went out to March of 2025. The at the money synthetic, the long call is $40. The short put is $28. So right there is a $68 exposure cost in the fund. You can't net out positives and negatives. You got to do an absolute value, right? So he'll pick up my trusty calculator. 68 divided by 177, which is the price of Tesla, is 38%. I would be in violation of ETF rules, not even including the value of my short call, which I haven't even put it in there. That would count too. So you have to go shorter in time to stay under the 25% concentration requirements. It's sticking with the ETF rules that drive us. But I would much prefer to go out farther in time. Options are a little cheaper. The cost of carry is cheaper because, right, a 1-year treasury cost is paying a yield less than, a 2-month and a 3-month. And if you could go out even multiple years, right, we know what the yield curve is doing these days. That's running at like 4%. The treasury cost, the interest rate cost, I should say, is reflected in the option prices. So I would much prefer, because we have an inverted curve, to be a little farther out, but we cannot.
Great answer. Yeah.
It's a real technical question. I would tell you that's a perfect example of, by the way, with ARK, we can go out farther because it's a diversified portfolio.
Yeah. It's like Apple, a fund of funds.
Right.
Yeah.
That's right. Yeah. I mean, you still, Apple just has lower volatility. We do typically go a little farther out on Apple as well. But again, we assess the cost to carry as we look at and that's minor, right? We're talking I know the distribution rate of 50%, like Jay, do you care about 3%, 4% cost to carry? We do. We look at it.
Yeah. This seems like a pretty good one here. For QQQY, can you talk about risk of making $1 from selling at the money put, but when it goes against history show, it loses 3 times that of the amount on the 0 date expiration? How do you mitigate that risk as a sub-advisor?
All right, so leave that question up there for a second for me. I want to make sure I understand it.
Yep.
Talk about the risk of making $1 from selling out the money puts, but when it goes against history shows that it loses 3 times that amount. So the down days, you're saying, exceed the losses on a down day exceed the amount that we made. Yeah, I think from our history, when we take a look at it, there's just more up days than down days, right? And so the idea of the in the money put, where you capture some of the appreciation of the Qs as well as capturing the time value associated with that, those you get more winning days than losing days. Yes, the losing days have a greater magnitude. It really is a preference between doing monthlies, weeklies, or dailies. For us, we know we get the maximum time decay from selling dailies. Like those have, the most time decay that you can have, at least close to the money time decays, right? If you're 10% out of the money, they don't decay very much. So those are better than selling them. We get more per day if you add up the 20 days in a month, the time decay that you get than selling one 20-day option that's near the money. But you're right. It depends. You can have an option. You can have a pricing dynamic where if you get like a minus 3% day, QQQY is going to be down 2.75, right? And then you get a up 3 day on a rebound, and QQQY is only going to be up 0.5%, right? That dynamic is what can cause the lag. But again, that same idea of earning time decay and alternative income is present in those strategies as well as YieldMax. And so while we don't have to spend too much time talking about the Defiance funds, it's something that we look at. And again, those are also all about yield, unless you look at the recent one. I think I saw somebody with a comment on SPYT, which recently came out.
Yep,
and
just did a video yesterday.
Mm-hmm. Yeah, those are designed for more upside capture, right? There's a target income. That's what the T stands for, target income. And then you can have more upside capture. So, for example, I'm looking at SPYT's performance today, right? The market what was the S&P up today? 1.12. SPYT was up 1.1, right? Captured almost everything on the upside today, but it will have lower yield than say JEPY or the YieldMax funds, because those are all about yield. SPYT is more about a target and then capture more of the upside. So I guess it all depends on what it is you're trying to achieve in the portfolio. But that's an example of, if you're going to go capture upside, don't sell strikes higher out. Use spreads, capture more upside once it gets through your credit.
Mm-hmm. Awesome. You just had a book sale from the live stream.
Oh, all right.
Up there.
Thank you. Appreciate it.
So we will do one more, should be easy question, then we'll end with a fun question.
Great.
Okay, so this person wanted to know, do you do like personal wealth management for people?
We do. Zega started out, we're a registered investment advisor. We do manage, individual client money. So I think we probably, between direct to wealth management or wealth management for other advisors, we get hired by other advisors to manage their client money as well. Probably in the range of 500 million we manage that way. So we definitely do that. It's how we started before we got into the ETF business. So I'm not pitching that you should reach out to us if you're interested, but it's fine. Happy to have a conversation. I have advisors in my shop that are registered under us that can help you out with that. Generally, we start at because it's so sophisticated what we do with the options, right? We generally start at the 500,000 mark for folks. But, I would give you, maybe a little, general advice, right? If you have a lot of years and you have, growth appetite, the stuff we're talking about here today can be a piece of that. But also SPY and QQQ, those are great investments for someone that's got a 20-year horizon. You don't need an advisor to get the S&P returns, right? So once you we think it's always more valuable to get to kind of that critical mass where, okay, now you're going to strip out different and be very deliberate about pieces of the portfolio. That's when we kind of kick in at that point. But we certainly do give personal advice.
Awesome. Good to know. Let's see here. Okay, one more. So everybody always loves it when you come on. This person said, when's the next one? So
I don't know. We're going to work through that. I think let's get some other funds, some more interesting ones launched. I think we definitely had some interesting things happen between our sessions. I love doing these, right? But I think you and I both have always agreed, let's give the folks something new. Me coming on and saying, 100 times. The objective of the fund is income first gets really boring and old and stale.
Spot
But
on. Yep.
yeah, so like we always talk about this. So as we have more interesting, more new funds coming out, absolutely, for sure.
Awesome. Okay, we'll end on a silly question. And I told the person I would ask this. So
Go ahead.
I was talking about, other discords and whatnot, and how, YieldMax is a polarizing topic, shall we say. So
Sure.
this subscriber of mine, he goes by the name Dissector, and
Okay.
he got banned from another discord because he said that YieldMax is risky, which you mentioned 4.5 out of 5. So I guess we're just looking for a soundbite here. So Dissector got called an idiot on that live stream. So would you say, is Dissector an idiot for saying YieldMax is risky?
There's certainly higher risk in YieldMax
Uh-huh.
than a lot of other investments. I'm not going to call anybody an idiot. I probably agree with him, right? Is it a him?
You agree with Dissector?
That they can be risky. Yes, of course. You're taking
Yeah.
Tesla risk. You're taking MicroStrategy risk. You're taking. I mean, I don't know if I'm so worried about Disney risk, but Disney can gap down 10%. It's happened
Yeah.
multiple times in the chart, right? So you're taking stock risk. So I would say it's risky because of the underlying. I wouldn't say it's risky because of the option structure or the high yield that pushes the NAV. If you don't understand, so I'll give you a positive comment on this one. I'll make it a serious comment. And I had if for anybody that saw the Bloomberg article and the Wall Street Journal article where I was quoted multiple times, the idea here is understand what you own, right? Nobody said these were safe. High yield should throw off a red flag like, oh, can I buy a treasury at 5% or this TSLY thing at 50? Yield, return and risk are always linked. Understand what you own. If you don't understand the ETFs, if you don't understand the dynamics of a covered call, they can be risky because you're not treating them properly, you're not trading them properly, you're not using them properly in your portfolio.
Mm-hmm.
You think, hey, I got 100K and I'm going to live off 50,000 a year with TSLY yield. That's not the way it works, right?
Mm-hmm.
It could work. Nvidia is a great example. That one's awesome, right? Yeah, by the way, the dividends are going up because the underlying is going up. You could make more than your initial, but you could also make less, and TSLY is a perfect example. So not understanding is the real risky part of these. But do I think they're aggressive? Yes, they are aggressive in general.
Awesome. Well, great interview. We're going to end it on that note there.
Thanks,
And
everybody.
thank you
Great as
so much
always.
for coming on. Great questions. For the audience, so we are going to continue on the podcast, but that one gets edited. So that one will probably be posted tomorrow or so. All right. Thanks, everyone, for tuning in. Awesome.
Thanks for having me again.
Yep.